Well, we got to talk about Jackson Hole now, and for that, we're going to bring in Maxwell Grinikoff, BNP Paribas equity derivatives strategist. And let's just kick this off because lots of chatter about the taper, transitory. Is it the case for inflation or not? What should we expect at this very important meeting?
Yeah, thanks for having me on again. So more than a few potential Fed policy related catalysts for equities on the horizon. We get the July FOMC minutes tomorrow, from which our economics team expects some guidance on timing and scope of taper ahead of Jackson Hole late next week and September FOMC at the end of September. So we've already started to see a bit of a backup in yields over the last couple of weeks on pretty strong jobs and inflation data. So we're using this as a bit of a playbook for the value growth trade in the equity space. If we do in fact see higher yields and the deliverance of a fiscal reconciliation package through the balance of Q3 and into Q4. And in terms of value, we've been more selectively focused on the quality side of value, as well as the more commodity and cyclical oriented parts of the market like materials and industrials.
All right, so if I'm hearing you right, you're expecting the yield curve to expand once again. We saw the 10-year yield kind of get off to a nice little start over the last couple of weeks, but then fall back down over the last few days. I'm just wondering, what's your outlook then, timing-wise, for this recovery, not only in the value and cyclical sectors, but also when we see that yield curve expanding again?
Yeah, that's a great question. Our U.S. rates team still does see higher yields, through the second half of the year. And like I said, that's been a bit of a playbook. We've seen a strong correlation between the value growth trade and the yield curve. But we've, as I sort of mentioned, we've been more selectively focused on the quality side of value. So looking at relative value strategies between sectors like materials versus financials, or even at the index level. We've been looking at things like Dow Jones versus the Russell 2000 to inherently implement this sort of long value plus long quality bias on our end.
So what's the opposite of quality there? I guess maybe zombie companies with bad balance sheets. I mean, what happens to them as interest rates take off? It could be a wave of bankruptcies, perhaps in at least the small cap space.
Yes, and small caps especially. So Russell 2000 for us has been a pretty strong conviction, short against some of our higher conviction, Delta One thematics, especially post the June month-end rebalance in the Russell 2000. You saw some pretty negative price performance. You also saw, a less favorable price to earnings backdrop post that rebalance. And that was really as a lot of, call it de-SPACed names and just lower quality corporates started to enter the Russell 2000. So that's played out quite favorably for our view for Russell 2000 and just the small cap space as a short.
And Maxwell, we've been talking a lot about retail today, given the retail sales data that was out, but also the big names that are reporting, Walmart and Home Depot. We've got Target on deck tomorrow. How are you looking at that space right now in the broader recovery picture? And what are some names that you're especially bullish on?
Yeah, so more broadly, just on the consumer discretionary space, that's been a space that we've seen pretty strong earnings momentum Q1 and into Q2. We've taken more of a nimble approach. We're looking at consumer discretionary sort of through the lens of GARP or growth at a reasonable price. Typically, what you'll find, especially in the ETF space, is strong weightings to a lot of the large cap, sort of tech e-commerce names. So we've found a more nimble way of implementing consumer discretionary exposure without having too much concentrated exposure in those particular names, and that's performed quite nicely relative to something like the XLY ETF, for example.
Well, before we go, I got to get your take on China and the Chinese stocks that have just taken an absolute pummeling this year. Most of them down, at least some of the larger cap names, down over 50%. The drive by the Chinese government to relentlessly pursue antitrust issues with these companies continues overnight. Where do you see this ending up? Might see some tradable bounces, but what's the long-term picture here?
Yeah, ultimately, what we focus on is how much that ultimately starts to bleed over into the U.S. markets. We did see over the last few weeks some headlines around the Chinese government starting to crack down on particular subsectors, and that did start to bleed over into the U.S. equity markets, particularly in the growth space. So certainly something on our monitor, on our radar. But at the end of the day, if you do start to see investors potentially move away from Chinese equities, that does present potentially some opportunity for capital to start to flow more into the U.S. equity space, particularly just given this, TINA argument for U.S. equities broadly. There is no alternative given this, just sustained lower yield environment we've found ourselves in.
Maxwell Grinikoff, BNP Paribas Equity Derivatives Strategy.